Good afternoon and welcome to Money Matters TV. I'm your host, Jeff Watkinson, Senior Vice President at Watkinson Capital Advisors located in Malvern, Pennsylvania. We have a very special guest today joining us in a little bit. But first, we're going to discuss the August CPI report, which came out this week. And we're going to discuss what to do with the recent CPI report. So this week, the August CPI report came out, and the reports of the death of the recent inflation surge are greatly exaggerated. The consensus thought that prices were going to come down 0.1% in the CPI reading. It actually went up 0.1%. So that was not good. Inflation year over year, the big headline number is 8.3% year over year. So in other words, if you had $1 million on September 14th, 2021, and you kept it in your refrigerator or under your bed, not in an interest-bearing account, today, that same $1 million would buy $917,000 worth of goods. It's an erosion of your purchasing power. This year so far has been a tough year for investors. How do we protect our purchasing power? How do we maintain and outpace inflation? Traditionally, people have invested in equities, stocks, which have been historically one of the best hedges against inflation going back over 100 years. Stocks have averaged over 10% since 1925, the Dow Jones Industrial Average. But they also balance their portfolio with bonds. And typically, stocks and bonds work in an inverse correlation. If stocks have a bad year, bonds usually do pretty good. One kind of ballasts the other. Well, this year, 2022, has been unique because both asset classes are down. So what do we do now? We have high inflation, the stock market's down, the bond market's down. What do we do now? Well, if it comes to bonds, we still have, it's a decision that we've been making, that we've been having to make since the financial crisis in 2008. We started our firm in 2009 when the Federal Reserve, in the wake of the financial crisis, was keeping rates very, very low, artificially low. And we are a municipal bond RIA. We work with individuals. We also sub-advise for other RIAs. And a lot of people said to us, I'm not going to invest in bonds right now. I think rates are going up. This is what they told us in 2010, 2011, 2012, 2013. Everybody thought interest rates were going up. I mean, that was 10, 12 years ago. They were keeping their money in money markets yielding essentially zero. And these money markets are still essentially earning zero. So flash cut to September 14th, 2022, today, you have $1 million. The same decision that faced you in 2011, 2012 faces you today. Now, we're going to examine the opportunity costs of staying in cash, earning nothing, and dipping your toe into municipal bonds today. And we're going to study, I went to business school. I like studying things at the margin. We're going to look at a daily accrual rate. So last night I made an illustration highlighting a hypothetical of $1 million investment. And on the left side of your screen, you see 3.6%. Today, we're finding yields in municipal bonds over 3%, 3.25%, even up to 4%. I made the numbers very easy, so I picked 3.6% versus the average, the money market rate paid at Charles Schwab right now. This is your alternative of doing nothing. So we're going to evaluate the opportunity cost of your $1 million investing today. If you were to look at municipal bonds, you'd earn 3.6%. That's roughly $36,000 per year in tax-exempt income. Your daily accrual rate is $100 a day. Think of it, every day interest accrues in these bonds, 360 days a year. If you bought a bond for 10 days and for whatever reason after 10 days you wanted to sell it, the buyer of that bond would have to pay you for 10 days of accrued interest. So think of it like a clock. Think of it like every day at 4 o'clock, $100 is hitting your account, accrued interest. The other alternative is, hey, I think rates are going to go up. That is the money market approach. Current money market rates, $100 per year in interest, less than 3 cents a day in daily accrual. So I've been working with this idea and I call it, I had a dream about interest rates and it came true. So let's say you have that $1 million and tonight you went to sleep and you had a dream. And in the dream, it told you interest rates are going to double from here. In 2024, the 10-year treasury is going to be, what is it, 3.4% today? It's going to be 6.8% in 2 years, on September 14th, 2024. You have your $1 million. You're going to have to make the same decision that you made today. If we go back to that illustration, had you stayed in cash, you would have earned $200 in accrued interest. Had you invested in municipal bonds, you'd have earned over $72,000 in accrued interest, which, if you were smart, you would have reinvested into the municipal bond market. So even if in 2 years you made that decision and you invested at 6.8% and you earned $68,000 a year in interest, how long would it take you to catch up to the person on the left who was in the market, was accruing interest, not trying to be cute, not trying to time the market? It would take a long time. It would take over 800, 900 days to catch up. And that's if interest rates doubled. If interest rates stayed the same, you would have no chance of catching up ever. So just like in equities, it's all about time in the market, not timing the market. And the most successful stock investors buy quality stocks. They don't overreact when the market goes too high or goes too low. They keep their fees low, and they're long-term investors. Well, the same thing goes for municipal bond investors. You buy high-quality bonds that provide good cash flow, investment grade. They don't have 20, 30, 40, 50-year maturities. And you reinvest the coupon payments. And if rates are higher, great, you reinvest at a higher rate. If a bond matures or is called, great, you reinvest. You keep that daily accrual clock going. Before we get to our guest today, we had a question from the audience. We had a question from Ruth Carpenter from Philadelphia. What's good about muni bonds in this market? Great question, Ruth. I'm going to give you the same answer I'm always going to give you, plus a little icing on the cake. People buy municipal bonds for their safety, for their predictable income, for their tax-exempt income. This is where wealthy Americans have stored and protected their wealth for generations, and to earn a higher yield than money markets, CDs at the bank. That's why people invest in municipal bonds. The icing on the cake is that in September 2022, yields are 2.5, 3 times higher than what they were in December of 2021. You can earn a lot more money. You can get your daily accrual interest rate clock ticking at a high rate right now in this marketplace. This time last year, the 10-year treasury was below 1.5%. It's at 3.4 right now. Municipal bond rates are a lot higher, providing the same safety and same predictability. If you have any questions that you'd like to submit to Money Matters TV, here's how you send in your questions.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Welcome back to the show. I am happy to introduce our special guest for today, Wendy Eldridge, Managing Director at Marcum Wealth. Welcome to the show, Wendy.
Thank you so much for having me.
Today we're going to talk about retirement planning, especially in a corporate environment, whether you're new to a company or new to the workplace. And we're going to talk about retirement plans. And, it's your first day on the job. What can I expect from a corporate retirement plan? How do I know if they have one? We're going to go through a lot of questions that a lot of people have had about retirement plans.
Awesome.
So, Wendy, let's start there. Let's say I'm new at a company. If a company offers a 401k plan, what are some important questions I should ask as a new employee or a new employee to a firm about the plan?
Absolutely. And what's so interesting is that through this great resignation that we're seeing, 401k plans, retirement plans have never been as important to prospective employees in the history of really, job search and jobs out there. Statistic after statistic shows that over 60% of people seriously consider taking a job based on those retirement plans and what the offering is. And so whether you are just, joining a company or you're looking potentially, at accepting a position, it is so important to ask these questions because a lot of times, we don't learn this in school. 401k is never a class in high school or in college. And so, the first question really that any employee wants to ask is, does your company offer some kind of retirement plan? Most employees equate a 401k plan with a retirement plan, but it doesn't necessarily have to be a specific 401k plan for a company to provide a contribution. So first and foremost, I would make sure that somebody asks, do you offer a plan?
Okay. You offer a plan. How much should I contribute and what should I invest in?
You got it. So those are going to be exactly kind of the next questions that we would encourage employees to ask. So first and foremost, really kind of that second question is, does your company offer any kind of matching contribution? And that sometimes dictates then what somebody is going to put away into the 401k plan. So, normally we recommend an employee asking, does your company offer any kind of a matching contribution? And from there, the follow-up question is, what kind of formula would that be? So if I put in $1, are you going to put in 25 cents or 50 cents on that dollar? So to ensure that you ask kind of what that formula is in terms of what the benefit might be. Now there are many companies out there today that can't afford to offer a matching contribution. And so we just always say to employees, that's never a reason not to enroll or not to join a 401k plan just because the company doesn't match it. But it's certainly ideal, if a company does provide those matching dollars.
Yeah, you obviously want to contribute the maximum to get the maximum match from the company, right?
Absolutely. And so that's why it's so important, Jeff, to ask what that formula is, because for us, when we talk to employees, we like to explain it this way. To us, it's free money And I feel like everybody loves free money. And so that's really what an employee is getting, is that free money. Now, oftentimes, employees that are their first job or coming out of college and have some student debt, and that's obviously a whole nother subject in itself, is student debt. But sometimes employees will say to us, well, Wendy, I just can't afford to put that maximum amount in. That's okay. So we encourage employees, put away what you can, at least take advantage of some of that free money, and then let's put a plan in place so that ultimately we can get to that maximum amount. So we take every single dollar we possibly can.
Is there a limit? Well, I mean, what are the limits to contribute to a retirement plan?
Yep. So, and this is interesting because we get a lot of questions. Are the limits the same in a retirement corporate plan as they would be if I have just an individual retirement account? So, within a 401k plan today, an employee is allowed to put away up to a total of $20,500. If somebody is going to turn age 50 or they're over age 50, they then are eligible for what is called a catch-up contribution, which allows them to put away an additional $6,500. So if you are 50 or going to be 50 or older, a total of $27,000. If you're under 50, the amount is $20,500. Now, again, a lot of employees are looking at me like, there's no way that, that I can afford that. And again, that's okay. We just want to make sure that you're taking advantage of it, that you are contributing something. And again, if there is that company match, to try to take advantage of it.
Okay. What if you work at a small family-run operation and your company, your firm, doesn't offer a retirement plan? Or what if you work anywhere that doesn't offer a retirement plan? What are some options? What should an investor, especially a young investor, middle-aged investor, consider?
Absolutely. And unfortunately, in this country today, over a third of employees do not have access to a company-sponsored retirement plan. So we really encourage folks that don't have access to open what are called individual retirement accounts. And so they can do this through an option like Vanguard, an option through Fidelity. You can also contact an advisor to help you open these kinds of accounts. So an individual retirement account is kind of like it says, is that it would just be individually, you're owning it versus being a part of a corporate retirement plan, but at least gives you the ability to put money away on a tax deferred basis. The limits are a little bit smaller with the IRA, so you can only put away up to a total of $6,000 in the IRA. But again, at least you're doing something towards that retirement. And the good news is that hopefully that family business that you're working for ultimately speaks to somebody about how great a retirement plan can be, and they develop one. Well, that IRA that you've already been contributing to could be rolled into that retirement plan if you wanted to, consolidate things and get them together. So a lot of options, but most important, to start saving today. Again, I think to follow up on what you had spoken about, that opportunity cost, it now is a wonderful time to start contributing, obviously, in whatever aspects you want to, and sitting on the sideline, we just don't want to do that today. So a lot of different options that you can have, whether, again, you want to be aggressive or conservative, but we want to get that money working today.
Okay, I have a question for you. Let's say you've maxed out your corporate plan, maxed out your IRA plan, you're at a good job. Are there any other options for tax deferral or ways to sock away money to plan for retirement?
Well, and that's really where we get into this, this hard spot for, employees out there who are really doing a wonderful job of saving. So as you said, let's say they max out on the 401k side, kind of max out on the IRA side. Where do we go? And we get this question quite a bit. Unfortunately, there's no real legal way kind of on the outside to be able to continue to defer tax in a qualified account. However, there are certainly opportunities to set up after-tax accounts. And again, something, when we think about an after-tax account, in investing in certain municipal bonds and investing in certain things that, again, we can try to defer the tax or we don't defer the tax, and having those things. So there are certainly opportunities to do that. Again, normally speaking, with an advisor can really set you up to be able to, we're going to invest this way, maybe in our qualified plans, and our outside accounts, maybe we invest a little bit differently to try to, again, get the biggest tax advantages that we can.
That's an interesting question. Like, I remember that from years ago. Like, you have a tax deferred account, an IRA, which has stocks, ETFs, mutual funds, bonds, whatever, and then you have your taxable account. How granular do you get, like which investments you put in each? And I mean, how's that work?
Well, it can be
That makes
very,
sense?
yes, no, totally. It makes a lot of sense because let's think about a retirement plan today. Let's say that, again, you've been investing in it for 25, 30 years. Well, as a reminder, all of those earnings along the way, you're not being taxed on those, correct? So oftentimes we have some employees who say, I want to be super aggressive in my retirement plan because I'm not paying those capital gains or whatever it may be each year on those. Whereas on my after tax accounts, maybe I'll have that as more of kind of my conservative. So yeah, so depending on that person's, personal financial, goals, they can definitely be different. And then I'm going to take it even a step further in that plans today, which can be very advantageous to employees, offer what are called Roth 401ks or after tax dollars. So employees can, if they decide that, you know what, Wendy, I want to get the tax, I want to get the tax out of the way today, you're able to put monies into the 401k plan, pay the tax today. And from that point forward, they grow completely tax-free. There are certain record keepers that allow you to invest those after-tax dollars differently than maybe your pre-tax dollars. So you can really get into the weeds with this.
Interesting. I sat down with my uncle last week, and he just retired a week ago, and he's asking me the difference between a traditional IRA and a Roth IRA, and he wants to buy a home. And can you run through for the audience like differences between a traditional and a Roth IRA? And yeah, that'd be great. Thank you.
Absolutely. So this is one item that I feel like can still be confusing for employees. So we put a lot of kind of responsibilities on employees when it comes to, investing or enrolling in 401ks or IRAs. And specifically in 401ks, we talk about, as we mentioned, okay, how much do we want to put away in this? So that's question number one. Question number two becomes, okay, how do we want to invest these dollars? So we got to go through what's available. And then question number three becomes, do I want to do it on a pre-tax basis or do I want to do it on an after-tax basis? And pretty much employees by that point are looking at me like I have six heads. But this can be a really, really unique way of setting yourself up when you get to retirement, just like your uncle is, in that distribution planning and what assets you're taking out, and paying taxes on. So within a 401k plan, if the plan itself allows both pre-tax and Roth, the limits are exactly the same in that you can only put away $20,500. You can't put $20,500 in a Roth and $20,500 in a pre-tax. It's all $20,500. Now you can do any combination you want, but you can't go over that $20,500. But what employees just need to think about is, do I want to pay the tax today and never pay it in the future? Or do I want to get that tax advantage where I'm not paying the tax today, it's going to grow tax deferred, but then when I pull it out, that's when I'm going to pay taxes on it. Now, with the Roth IRA and an individual IRA, really kind of the same thinking, but what's really advantageous about the Roth 401k is that with a Roth IRA, there is an income limitation. So if you make over that maximum amount, you aren't even allowed to have a Roth IRA. In addition, obviously, the limits are much less within that Roth IRA than they are in the 401k at $6,000.
Interesting. I have a question, and it's a little off script, but a friend of mine I shouldn't say rate, he borrowed from his 401k, bought a condo, like really bought himself a condo. And, would you recommend that? If it worked out for him, but I was curious what your thoughts are if you're 28, 29, 31 years old, like, I want to buy a place. What are your thoughts on that, Wendy?
Yeah, so it's funny that you should say that, Jeff, because I've actually had 3 instances within the last couple months that folks have posed those questions to me. And so it really comes down to a lot of different factors. Number one, the plan has to allow loans to be able to borrow from it. But if it does allow loans, really we look at a couple different things. So if that person was to go and get a loan at the bank, what is the interest rate going to be that they're going to have to pay? What are the charges going to have to be? Within a 401k, if you take a loan out, you are actually paying yourself back with interest. Typically, it's the prime rate plus 1%, but the interest and the principal amount is all going back into your account. So a lot of times employees will say to me, well, several months ago when interest rates were very low, think about what I could be getting in using this money, Wendy. I'm paying myself back versus what I would be doing on the outside. But obviously we have that big stop sign that, if you were to leave or you to be terminated, you have to pay that loan amount back or it can become a distributable event. So we really have to work through a lot of the specifics to ensure that it is the right decision.
Interesting. Do these accounts have beneficiaries?
Yes. So again, in this instances that we're these times that we're living in, both an IRA, so somebody doing it on the outside, as well as retirement plans, have beneficiaries that have to be tied to this. So very important that I hope that all the listeners today, please make sure that you're checking all of these accounts, because it is imperative that you have a beneficiary listed. If you're not married and you don't have a beneficiary, it is going to go into probate, which is the worst case scenario. So please make sure that you are checking both IRAs, life insurance policies, annuities, 401k plans. Make sure that you are double checking. And as I always say, if you don't have anybody, by all means, please feel free to contact me and I can give you my information.
I think I remember this from a past life, but doesn't a beneficiary on an IRA, doesn't that override a will?
Yes, it does.
Okay.
And if you have a beneficiary in there that you meant to change, whether you got a divorce or you had somebody else, it's still going to override it. So that's why it is extremely important that you check that.
I've heard a lot about fees with 401ks, hidden fees. I mean, I know you're investing in mutual funds. How do you really figure out what are we paying here? What exactly is happening here?
Yeah, and this is extremely important today, especially with the amount of fee compression that we're seeing within this space, both, as you said, from just an investment perspective, but also from a plan perspective. So you are required by law on an annual basis to receive a disclosure notice if you are in a 401k plan. On that disclosure notice, it should state exactly what all the fees are. But if you should have any questions, because normally that document is about 100,000 pages long and can be very hard to understand. I know. So what I really highly recommend that you either call the company that the 401k plan is with, or you call maybe the record keeper, a custodian, and simply say, please tell me what fees I'm paying. And they have to tell you exactly what you are. But I think that is something that, again, maybe 10 years ago or 20 years ago really wasn't at the forefront, but we definitely encourage that, Jeff.
Wendy, thank you so much. If you have any questions about retirement or retirement plans, please reach out to Wendy Eldridge, managing partner at Marcum Wealth. I want to thank everyone for a great show today. Next week, our guest is Clement Pepe, business coach. So tune in next week to Money Matters TV. This is Jeff Watkinson wishing you a great day. Take care.